In 2017, the United States witnessed one of the most significant tax overhauls in decades with the passage of the Tax Cuts and Jobs Act, spearheaded by the Trump administration. This comprehensive reform promised to cut taxes for individuals and corporations, spurring economic growth and creating jobs. But who truly benefited the most from these sweeping changes? At the heart of the reform was the reduction of the corporate tax rate from 35% to 21%, a drastic cut aimed at making American businesses more competitive globally. This change was a boon for large corporations, significantly increasing their after-tax profits. Consequently, many large companies saw a surge in stock buybacks, which bolstered their stock prices and directly benefited shareholders. Critics argue that while this spurred stock market growth, it disproportionately favored wealthy investors and executives, rather than channeling funds into workers' wages or new investments. The tax reform also introduced changes for individual taxpayers. It increased the standard deduction, nearly doubling it, which simplified tax filing for many Americans and reduced taxable income for millions. However, to offset these changes, the personal exemption was eliminated, a move that affected larger families who previously benefited from multiple exemptions. Additionally, the reform introduced new limits on state and local tax deductions, popularly known as SALT deductions. This change particularly impacted residents in high-tax states like New York and California, where state and local taxes often exceed the new $10,000 cap. Many middle-income earners in these states found their tax liability unchanged or even increased, sparking considerable controversy. Small businesses received attention through the introduction of a 20% deduction on qualified business income, meant to aid pass-through entities such as S-corporations, partnerships, and sole proprietorships. However, the complexity of these provisions created confusion and uneven benefits across different business structures and industries. The reform's impact on the federal deficit is another crucial aspect to consider. The Joint Committee on Taxation estimated that it would add over $1 trillion to the national debt over 10 years, raising concerns about future economic stability and the burden on future generations. While proponents argued that the lower corporate tax rate and individual cuts have stimulated economic growth, increased business investment, and reduced unemployment rates, critics assert that these benefits have been unevenly distributed. The wealthiest individuals and large corporations have seen the greatest gains, amplifying income inequality and raising questions about the reform's long-term efficacy. In conclusion, Trump's tax reforms brought significant changes to the American tax landscape, benefiting different groups in various ways. While large corporations and high-income earners saw substantial gains, the impact on the broader populace remains a subject of debate. As with any policy of this magnitude, its true legacy will likely be judged by future economic conditions, ongoing debates around income disparity, and potential tax legislation responses in years to come.